Okay, just a quick video to discuss partnership accounts with my lovely board notes. So see if you can read my writing as well. So just a summary of the content for partnership accounts on A2 level accounting. So first part we've got here is an appropriation account. So what we've got to remember, the whole purpose for appropriation account, if I could say it properly, an appropriation account is to find out how much profit is going to be distributed to each partner. Now, if you're a sole trader, it's nice and straightforward because the profit is for the owner. Whereas with the partnership, you've got multiple owners, so it's not as straightforward to determine how much profit each one gets. However, if you're an informal partnership, so that is one without a partnership agreement, it is pretty straightforward because profits, as it indicates on the left-hand side, profits are shared equally. So every partner gets an equal split of the profit achieved. So you'd have your profit for the year, that is after the deduction of any partnership loan interest, and that is shared equally. So if you had partner A and B here, they would get 50% each. However, if you had a formal partnership agreement, so that means you've got a deed of partnership, you've got a contract, then lots of different aspects could happen. Firstly, with a formal agreement, you can determine whether one partner has a salary. If we have a salary, that is deducted from the profit for the year after the profit for the year has been calculated. You need to stress the partnership income statement. All of these adjustments, this is separate. A partnership salary is not treated as an expense because it is a payment to the owner or an amount that the owner can take out. So we have the profit for the year, we'd have salaries. Make sure you indicate if you are completing an appropriation account that salaries will be deducted. You can lose marks if you don't put brackets where they should be included. You need to clearly be showing what's happening to the profit for the year. So obviously salaries is a distribution, so that will be reducing the profit for the year. Interest on drawings. So interest on drawings is a penalty. So there's a penalty if one partner takes out drawings. And so we agree as part of the deed of partnership, if it isn't mentioned in the question, there are no interest on drawings. So if it's not there, don't include it. The amount of times that students include interest on drawings but it's not included is too many times. Well, one is too many times. But anyway, interest on drawings, if they are there, you add them back, because what an interest on drawing does is it's a penalty for one partner taking out money from the business. So it's trying to discourage high levels of drawings. By adding it back, that increases the amount of profit available for distribution, which means that the other partner benefits because the partner's taken out drawings. So it's another disincentive for taking money out of the business. Finally, we have interest on capital. So interest on capital could be agreed on within the partnership agreement. And again, it's only if it's stated interest on capital, interest on drawings and salaries that we include it. Interest on capital will be taken away because it is a payment to the partners. So it's an extra amount of money the partners could take out of the business. So it's not usually, it is a percentage on the capital investment, and it does encourage partners to invest more capital because they see they will generate a return from doing so. Once you've added or taken away all of the salaries, interest on drawings, and interest on capital from the profit for the year, you then have what we call residual profit. You have to include this figure. Sometimes that's an own figure in an exam question. So residual profit is how much profit you've got left after those deductions. At that point, you will then share it according to the profit sharing ratio. So you just distribute that residual profit according to what you've been told in the question. So if it was 30% to one partner, 20% to another, 70%, 70, really, 50% to the other, then that would be the split. But again, that's own figure, so make sure you do it, even if you think you're not 100% right. Top corner there, I've written split year. The more complex appropriation account questions have split years, and normally in an exam, that's what you would expect to see. So by split year, what would normally happen is you would have a statement that says profits are accrued evenly or profits are evenly distributed throughout the year. And then what you've got to work out is how many months apply to each part of the question. So you have to think about very carefully, maybe get your fingers out, January, February, March, 3 months, whatever it might be. So then you divide the profit by 12 and multiply it by the amount of months and just put that in each of the parts of the year. If the partnership agreement changes at one part of the year, then the proportion of salaries, interest on capital, interest on drawings changes as well. So you need to make sure if a salary is only for one part of the year, that you only charge it for 1 month a year. So if it was half the year, you just do 6 months of that particular salary. If interest on capital changes 6 months through a year, you do 6 months at the old rate, 6 months at the new rate, and show your workings. So just be careful. So appropriation account, the first one. Now we'll look at the current account. So the current account, we have a separate current account to the capital account. So capital is measuring the amount of investment that the partner has put into the business, whereas the current account is the short-term movements. So it helps the partner to understand how much money they can take out of the business, because it shows their share of the profit that's been generated, and also other money that they have taken out of the business, or that they could take out of the business, sorry. So the opening balance on a current account can actually be on either side. You would expect it to be on the credit, because the current account is a form of capital account, in that the current and capital account combined represent the investment in the business by the owner. So you would expect it to be on the credit because you owe the partner money. However, the opening balance could be on the debit. Now, if it is on the debit, that means the account is overdrawn, and that means that that particular partner has taken out more in drawings than their profit share. Anything on the credit side of the T account increases the amount of money that the partner can take out of the business. So salaries clearly is something that partners would benefit from. Interest on capital, interest on any partnership loans will go in their current account, and finally, if there's a profit share, it will be included on the credit side. On the debit, we have drawings. Now, drawings were not included in the appropriation account. If they were, that would mean that other partners have less of a profit share because one other partner has taken money out, which clearly would not be fair. So we have drawings, we have interest on drawings, and loss share. So all the items that would decrease the value of the current account. Then the balance carried down and subsequently the balance brought down would help the partner to appreciate how much money they can take out of the business. On the bottom half of the slide, or the whiteboard notes, is what we call the revaluation T account. So we're looking at revaluations. They generally happen when there's a change in the partnership. So what I mean by change is a new partner being introduced to the business, or one of the partners retiring. So what you're trying to do is establish a fair value of the assets and liabilities of the business to determine how much money the new partner should pay, or how much extra the new partner should pay, or how much money we should pay the retiring partner to make it fair. At the bottom, it quite clearly states there's never going to be a balance carried down on this T account. This is because it is a temporary account. Need to add, my writing being clearly is probably not the right phrase to use. So when we're looking at revaluations, we're looking at increases in values of assets or liabilities, or the PDD, or the provision for doubtful debts. So assets going up in value, so assets increase on the debit, so the value or the amount that the asset is increased in value would therefore have to go on the credit side of the revaluation account. So you'd put the name of the relevant asset and the increased value. So if it was 10,000 and revalued to 12, it would be a 2,000 credit item. The provision for doubtful debts, if that goes up, a provision is effectively a liability because it's a liability of uncertain timing and amount, and provision for doubtful debts is basically saying that our trade receivables will fall in value in the future. So if the provision for doubtful debts increases, that would go up on the credit, so therefore would be included on the debit side of the revaluation account. It has to say that subsequently the asset going down would go on the reverse side to the asset going up, so that'll be on the debit, and the PDD going down would go on the credit of the revaluation. Finally, you could have a liability such as trade payables, and that would go up and down on the same side as the provision for doubtful debts. So an increase in liabilities would go up on the debit and go down on the credit. Now, once we've done that, and go back to the idea this is a temporary account, there's no balance carried down, so the balance carried down is shared in proportion to the existing profit sharing ratio. You would normally anticipate the balance carried down will be on the debit side of the T account, because that would reflect a credit entry to each of the partners' accounts to reflect the increase in value of the business. However, there's nothing to stop it being the other way. And so if that's the case, you would obviously have it on the credit side of the revaluation account, which would go on the debit of the capital. But the revaluation helps us to establish a fair amount to pay those partners. And now let's have a little look at the T accounts for retiring and new partners when it comes to the capital. So final slides here. So we've got an introduction of a new partner. So when we're introducing a new partner, we're trying to find a fair value. So they're paying the right amount because they're going to benefit from a successful business. And so therefore the existing partners should be paid a premium or an extra amount to reflect the amount of work they've put in to build this business up. Intercapital account to the balance brought forward has to be on the credit. So if you look here, we've only got a balance brought forward for A and B. That's to reflect it's only the existing partners who would clearly have a balance brought forward. Goodwill, which is the amount that a business is valued over and above its net asset value, would be negotiated between the new partner and the existing partners to provide that premium to reflect the amount of work they've put in to build this business up. Goodwill is an asset and it would increase on the goodwill account on the debit, so therefore goes on the credit side on the capital account, increasing the value of the capital account to reflect the fact that the owner has actually now got a higher investment because the assets that they purchased are worth more money. However, goodwill is not an item that's allowed to be kept in the accounts, and so we have to remove it. So you'll note that goodwill is on the debit side of the capital account, but now is shared by the new profit sharing ratio. This means that the existing partners would have a credit entry and 2 debit entries for a smaller amount, meaning that their capital accounts will go up in value to reflect that they've been paid, well, a premium for the new partner to be introduced. As C, we've got a debit entry for goodwill, but has no credit entry for goodwill. That means that their actual closing balance will be lower than their investment because they have paid that premium for goodwill. So you can see on the credit side of the T account, the investment for that new partner would be entered on the credit and labeled as bank, assuming that the investment is in the form of cash, and that would help to lead to the lower balance brought down. There could be the revaluation, and so if there is a revaluation, it is only to the benefit of existing partners. So we'd put the revaluation as a credit entry for the 2 existing partners, and then C, or the third partner, is paying for that. And so then we've got that fair value. Now revaluation can be on the debit if they've fallen in value, and again it's in the existing profit share. Other than that, we could have a retiring partner. So from a retiring partner point of view, you're trying to pay that person leaving the fair amount of money. So the opening balance will be on all 3 partners, because, or however many there are, because that's reflecting the fact that all the partners have existing ownership and existing money tied up in the business. We would then introduce goodwill again, but introduce goodwill also in the existing profit sharing ratio, but that means that each of the partners would actually have a proportion of that linked to the profit share. Now, when it gets removed, we only put the debits for the remaining partners, those who are going to remain after the retirement. What that means is the 2 partners who are remaining will have a usually declining capital account balance. That's to reflect the additional money being paid to the retiring partner. So the decrease combined in the existing partners will be effectively paid to the retiring partner. One extra step that needs to happen if there's a retiring partner is to clear the current account, because any money that is in the current account needs to be paid out. So it just goes into one account to make that easier. So that can go on the debit if it's overdrawn, or on the credit if there's money in the current account. So we just put those across. Then what we've got to do finally is pay the retiring partner. Now, if there's sufficient liquidity in the business, there would just be a bank entry on the debit side of the T account to reflect that it is money out of the business, because there'll be a credit entry in bank on the other side. Now, sometimes the business may not have liquidity to pay that to pay that money from the bank. And so what they would do instead is they would organize a partnership loan to make up the overall amount of money for the retiring partner. They will no longer have a balance as a capital account, but they would have a partnership loan that would sit as a non-current asset and receive interest until it's paid off. Sometimes in an exam question, you're asked to maintain a certain level of capital account for the remaining partners, and that would involve either a credit entry with bank to top up an account, or a debit entry for bank for the amount of money that needs to be paid to them to decrease it to that value. So you can have partnership questions across all of those types. Make sure that you can complete appropriation accounts, capital accounts for retiring and new partners, current accounts, and you can complete a revaluation. Just to clarify, the revaluation could still happen on the retiring partner layout, but it seems silly having lots of the same things. Okay, good luck.